Welcome to the Deep Dive. We're here to cut through the noise, get straight to the insights. And today, wow, we are plunging into a really compelling stack of sources. They paint a vivid, sometimes pretty unsettling picture of our current world. We've got articles, research. It spans everything from national economies, global markets, right to the cutting edge of digital finance. It is a lot to process, I know, but our mission is pretty clear. Help you extract the most important nuggets of knowledge and, connect the dots.
Exactly. We're sifting through what some people are calling Britain's slow crash. We're exploring this golden age of grift in global markets, charting a really rapidly evolving geopolitical landscape. And all this is happening while a completely new financial architecture seems to be emerging in crypto. What's truly fascinating, I think, is how these trends, which seem disparate, they're not isolated at all. They're deeply interconnected. And understanding those links, well, that's crucial for navigating whatever's coming next.
Right. So if you're looking for that shortcut, to understanding these major themes, getting those specific data points, the surprising facts, the underlying implications, all curated just for you, then yeah, let's get right into it. We're starting by taking a very close look at the UK because, frankly, our sources paint an alarming picture, a nation with some genuinely creaking pillars.
Yeah, creaking pillars is a good way to put it.
And the most immediate sign, the most tangible one highlighted, UK concrete demand. It has collapsed. Collapsed to levels we haven't seen since 1963. Just think about that for a second. The very foundation, housing, infrastructure, industry, it's essentially stalled.
It really is stalled. And you mentioned housing.
Yeah.
And planet reform. Still stuck. Pledges like, say, Starmer's 1.5 million homes by 2029. Our sources are calling that a fantasy.
Fantasy, yeah. And they even connect the current shortages directly back to past policies, citing right to buy specifically, saying it sort of gutted the social housing stock over decades.
Absolutely gutted it. And it leads directly to this other stark reality, what's been termed Britain's tax trap. What's compelling here is the mathematical reality that earning £100,000 can actually leave you worse off than someone on benefits.
That sounds counterintuitive. How does that work?
Well, look at this specific example from the sources. A family, £100,000 household income, two parents, each earning £50K. Okay, after you factor in childcare and rent, they're left with just £24,800. Now compare that to a family on benefits, running the exact same house. They could clear £30,000 after rent, and crucially, with no childcare costs.
Wow. That difference is stark.
It is, and for those earning a bit more, say between £100,000 and £125,000, they only keep about £38 out of every extra £100 they earn. It's quite something.
That's just a brutal disincentive, isn't it? For ambition, for productivity, especially for the middle class. But these aren't just economic numbers, are they?
Yeah.
The sources seem to touch on something deeper, a sense of wider cultural unease.
Absolutely. The reports definitely reveal a growing sense of, cultural cracks. You have observers like Rod Little describing London as practically another country where multiculturalism is starting to feel more like parallel societies.
Parallel societies. That's a strong phrase.
It is. And there's this pervasive sentiment described that ordinary people feel like strangers, in their own postcodes. Even the Union Jack itself is becoming, quote, subversive. It points to a profound shift. National identity, social cohesion, under significant strain, far beyond just the economic figures.
So, okay, traditional industries seem to be declining. The middle class is caught in this tax trap. Who is actually paying the bills in modern Britain then? Our sources had a really surprising insight here that, honestly, I didn't see coming.
Yeah, it really challenges the conventional wisdom, doesn't it? The surprising truth, according to these sources, about Britain's modern tax base. It's not traditional industry driving it. Not anymore. Instead, it's described as mathematical genius, quants, bookies, and porn merchants. They're the largest contributors to the exchequer now.
Seriously, like who specifically?
Well, think of entities like Alex Gurko's XTX Markets, the high-frequency trading firm. Think Bet365. Think the founders of OnlyFans. It profoundly highlights a shift, doesn't it? Away from, say, productive capacity towards, monetizing human weakness, if you want to put it that way.
That's quite a statement. And what does that mean for investors? You mentioned a moron premium.
Yeah, that's the term used. It implies that for most UK investments, there's this built-in moron premium.
Okay, break that down. What does moron premium actually mean in practice for someone looking at the UK market?
is a blunt way of saying investors are demanding a much higher return, that's the premium, to compensate for what they see as a lack of quality. The structural issues, the weaker growth prospects overall in the UK market, they're basically pricing in a higher degree of uncertainty and weakness. So many investments just don't look attractive unless they come with significant discounts or, potentially huge returns.
So where are investors looking then?
The sources identify energy, offshore, and defense as maybe the few sectors where brave investors are still targeting opportunities. So the critical insight here, maybe the takeaway, is that this kind of system risks creating a sort of moral hazard, where policies might inadvertently end up rewarding non-productive sectors and penalizing ambition, making genuine long-term productive investment harder and less attractive.
That question about where true value is being created, it's profound, especially when you think about how fast global economic power is shifting. It actually sets the stage perfectly for our next segment, this idea of a golden age of grift in global markets. This is where we really start to see some fascinating and, yeah, sometimes alarming patterns emerge. First up, that central bank obsession with the 2% inflation target. Dead, apparently.
Absolutely, dead and buried. Our sources say it's somewhere next to Blockbuster's last VHS tape. Gone.
Okay. So if 2% is dead, what does that mean? Especially for, say, the bond market.
No, it has huge implications. The idea described is that buying long-dated treasuries, even if they're yielding 6%, is like volunteering for a mugging.
Volunteering for a mugging. Why so harsh?
The rationale presented is straightforward. Governments simply need inflation. They need it to erode their massive debts. The sources suggest they're basically going to cook the books until the ink runs dry. Meaning, inflating away debt will be prioritized over hitting some arbitrary inflation target.
Right, makes sense in a grim sort of way. Then you've got the AI mania. The S&P 500, the NASDAQ, they've absolutely defied all the doom predictions. It's described as hype and hope on turbo. Look at NVIDIA, its valuation is stretched, right? 41.1 times its January 2026 earnings per share. That's pretty wild.
It is pretty wild. And those data center capex numbers are just staggering. We're talking $600 billion next year alone, projected to hit $3 to $4 trillion by 2030. For context, as the sources point out, that's comparable to Germany's entire GDP. It's almost unbelievable.
Almost unbelievable. Yet, despite all these concerns, the market's described as unshortable. Just because of the herd?
Pretty much. The herd mentality seems overwhelming. But what's really compelling, I think, is the contrast the sources draw. While NVIDIA is soaring on this wave of, enthusiasm, they point to Qualcomm. Qualcomm is highlighted as maybe the cheapest large-cap tech stock out there, trading at just 13 times earnings. And it has robust $9 billion in annual free cash flow.
Okay, so Qualcomm is the value play in this AI narrative.
That's the argument. They're seen as selling the shovels that go in your pocket, powering AI on phones, smart glasses like the Meta Ray-Bans. It's less speculative, more foundational. And beyond tech, commodities are having a huge resurgence. Copper, tungsten, uranium, they're called the new rock stars.
Rock stars, okay. What's driving that?
Well, take uranium. Gazprom, the big Kazakh producer, made a really strategic move. They cut global supply by 10% with an option to cut even more, up to 20% below contract levels. That alone has turbocharged the bull case for the whole uranium sector.
And tungsten, that's not just any metal, is it? It's actually critical.
Precisely. China absolutely dominates tungsten. They supply something like 82.7% of global demand, hold over half the world's reserves. And it's crucial. Military uses, think armor-piercing munitions, tank armor, but also vital for next-gen tech. Solar panels, semiconductors, even nuclear fusion research.
Who else produces it besides China?
Vietnam, Russia, North Korea are the other key suppliers mentioned. So you see the strategic importance. And interestingly, in terms of comeback kids, Peloton gets a surprising mention in our sources.
Peloton?
Oh,
really? After all their struggles?
Yeah, apparently they're rebranding, moving away from just being a bike company to becoming an AI fitness cult. They're pushing something called Peloton Intelligence, focusing on those high-margin subscription services. And the margins are strong, reported at 69%.
An AI fitness cult. Interesting pivot.
It is. So I think the key takeaway from this whole market section is, yeah, there's definite froth in some areas, like maybe AI hype, but there are also these fundamental shifts happening. Real-world value is being created and invested in less obvious places like specific commodities or potentially undervalued tech.
Okay, so from the twists and turns of global markets, let's think about how these economic shifts are tangled up with the power plays on the global geopolitical stage. Empires, escalation, underpriced power. How are these shaping things? Let's start with Russia. Our sources use some pretty blunt language, calling it a knackered colonial project and a petrol Walmart with nukes.
That's the description, yes.
Mm.
Facing appalling demographics, a brittle economy, and there's even mention of Siberia being potentially eyed by China in the long run.
And the war in Ukraine, what's the outlook there according to the sources?
Grimly, it seems to be heading for escalation, not resolution. That's the assessment. Kiev is reportedly developing these flamingo strike systems, capable of hitting deep into Russian territory, deep behind the lines. And they've apparently stated their independence from U.S. red lines on targeting.
Independence from U.S. red lines. That's significant.
Very. Meanwhile, Russia is reportedly stepping up its strikes on NATO supply routes. So it clearly signals a deepening conflict. The investment conclusion drawn from all this. A strong case for deeper militarization. And the advice is pretty direct. Stay long European defense. The thinking is that the demand cycle for this sector has years left to run.
That's a compelling argument for staying long European defense, but given how complex global conflicts are, do the sources mention any big risks or counter-arguments to that strategy?
That's a really good point. Yes, while the demand seems clear, the main risks identified are things like political instability within European nations themselves, the potential for some unforeseen diplomatic breakthrough that could suddenly dampen demand, unlikely perhaps, but possible, or even just the sheer scale of the conflict widening beyond current projections, which could bring in totally new, unpredictable factors. But that said, the prevailing view seems to be that this current rearmament cycle is just too deeply entrenched now to be easily derailed.
Okay, so defense looks like a long-term trend.
Yep.
How does China fit into this complex geopolitical puzzle then? It's portrayed differently, right? As an undervalued giant.
Exactly, an undervalued giant. And there's a really stark comparison made to illustrate this. You take the Magnificent Seven tech companies in the West, their combined market cap is around $17 trillion. Massive. That absolutely dwarfs China's entire tech sector, which is valued at maybe $1.5 to $2 trillion. So what, 10–12% of the Mag 7? Tiny in comparison.
Wow, that is a huge difference in valuation. Is it really just Beijing's paranoia driving prices that low?
According to the analysis, yes, that's a primary driver. Beijing's paranoia, the regulatory crackdowns, they've definitely hammered prices.
Mm-hmm.
But the flip side is, it also means that in many cases, cheap is cheap. So from an investment angle, the suggestion is maybe taking cautious long positions in China tech.
Like which ones?
Well, examples given include Alibaba, trading at about 14 times forward price to earnings, or Pinduoduo at around 8 times EV/FCF.
EV/FCF, remind us what that is.
Right, enterprise value to free cash flow. It's basically a valuation multiple. It shows you how much it costs to buy a company relative to the actual cash it generates. You can give a clearer picture of value sometimes, beyond just reported profits. And this whole China investment thesis, for some, it's seen as part of this huge long-term trend in ongoing 1,000-year global GDP % mean reversion.
1,000-year mean reversion. Wow, that's long-term thinking.
Very long-term. Predicting a gradual rebalancing of global economic power back towards historical norms. So the key takeaway here, I think, is that in this world of escalating conflicts and shifting economic power, you often find overlooked opportunities where fear has maybe driven valuations down to extremes, especially in critical sectors or regions perceived as undervalued.
That's a really crucial perspective for anyone trying to navigate these turbulent waters.
Okay, now for our final section, and maybe the most transformative shift of all, the evolution of finance itself. As the existing system, creaks under debt and inflation, what does all this mean for the future of our money, for the financial system?
Right. This brings us squarely into what's being called the new financial architecture. And there's a really powerful analogy used in the sources to capture this. Clearing banks today are Blockbuster in 2008, while stablecoins, they're the Netflix of finance.
Blockbuster versus Netflix. That's incredibly vivid. So are stablecoins really disrupting traditional banking that much, and how exactly are they doing it? The sources argue they absolutely are. Look at Tether, just as one example. It's apparently moving more money daily than most European clearing systems. The core appeal: instant, global, low-cost settlement. It's a world away from the days it can take traditional banks just to move cash across borders.
Instant, global, low cost. That's compelling.
Hugely compelling. And you've got major players like BlackRock, like PayPal, already showing significant interest. They see these stablecoins as the new rails for the financial system. It's really moving beyond magic internet money now. This is seen as a fundamental shift in infrastructure that just bypasses a lot of the slow, expensive legacy systems.
Okay, so stablecoins are the rolls. And within this new architecture, our sources talk about crypto's horsemen, these core digital assets forming the backbone. How do they break those down?
Yeah, crypto's horsemen, we can sort of categorize them based on the descriptions. First, you've got Bitcoin. That's positioned as digital gold, described as the cold, ugly, but indestructible reserve asset. Fixed supply, 21 million. It's the ballast, the foundation.
Okay, Bitcoin is digital gold. Makes sense. What's next?
Second, Ethereum. This is framed as a global settlement layer and programmable money. It's even presented as potentially the biggest macro trade for the next 10, 15 years. Why? Because it's seen as an operating system for the whole financial internet. Not just a payment rail, but a platform where trillions in tokenized assets, stocks, bonds, real estate, you name it, could eventually settle on chain.
An operating system for finance. That's a big vision. And the third horseman.
Third, there's Solana. This one's often called the Soho House of Crypto. You know, flashy, fast, designed more for a dopamine hit, not posterity. But despite that flashy image, there's serious institutional confidence building. Names like Galaxy Digital, Multicoin Capital, Jump Crypto, they're reportedly raising $1 billion for a dedicated Solana treasury. And Solana Mobile even has ambitions to challenge Apple's 30% take from the App Store.
Wow, challenging Apple's App Store fee. That is ambitious. Okay, so Bitcoin, Ethereum, Solana. What about some of the other, maybe lesser-known innovations shaping this?
That brings us to things like Helium and DePIN, the decentralized physical infrastructure networks. Helium specifically has had quite a journey. From what was once seen as maybe a bedroom gimmick, it's now reportedly birding real data. Driven by mobile adoption, and it has deflationary tokenomics. It's positioned as a kind of hidden play on connectivity for what could be a decade of renewing telecom infrastructure.
Decentralized infrastructure. Interesting. So is crypto replacing the old system entirely then?
Not necessarily replacing it wholesale. The view presented is more that it's rebuilding it into a kind of hybrid model, where Wall Street central banks, they'll eventually run their plumbing over these new blockchain rails. It's about upgrading the infrastructure. And you're seeing institutional acceleration everywhere. Look at Metaplanet. They've notably got Eric Trump on their board, and they're strategically aiming to accumulate over 21,000 Bitcoin by 2025.
Eric Trump on the board, aiming for 21,000 Bitcoin. That definitely signals mainstreaming, doesn't it?
It certainly suggests a level of institutional seriousness and strategic positioning. This isn't just about speculation anymore, not at this level. It's about what the sources call the deliberate construction of a new monetary order. And from an investment perspective, if you buy into this, it might suggest a kind of split treasury approach. Bitcoin for ballast, ETH for the infrastructure play, Solana maybe for the high growth upside, and something like Helium for optionality on connectivity.
Okay, wow. We have covered a huge amount of ground today, from the really deep challenges facing the UK, those creaking pillars, the changing tax base, all the way to the global shifts in markets, that golden age of grift, the rise of commodities, then through the geopolitical chessboard, and finally right into the changing nature of money itself with this new financial architecture emerging in crypto.
Indeed. It's a complex picture. We've seen how established systems are, well, visibly creaking under the strain. While at the same time, new technologies, new power structures, they're rapidly emerging. It's complex, definitely contradictory at times, but also, as we've seen, potentially a very opportunity-rich landscape that demands our attention.
It really does.
And this entire deep dive, I think, highlights a really crucial lesson, one attributed to John Paul Getty. In times of rapid change, experience can be your worst enemy.
Experience as your worst enemy.
That's
it's provocative.
It is. So maybe as you go about your day, the thought to leave you with is this. What established experience, what assumptions based on how things used to work might you need to question or maybe even set aside to truly understand and hopefully thrive in this rapidly evolving world we've been discussing?
Disclaimer. North Breach Limited, Nutstuff trading name, is an appointed representative of Messels Limited, which is authorized and regulated by the Financial Conduct Authority. Nutstuff has made every reasonable effort to ensure the information provided in this communication is correct. But Nutstuff makes no representation nor any warranty as to whether the information is accurate, complete, or up to date. To the extent permitted by law, Nutstuff accepts no responsibility for any errors or misstatements, negligent or otherwise. Nutstuff, its associates, officers, or employees may also have interests in the financial instruments referred to in this information by acting in various roles. The information in this media is confidential. If you are not the intended recipient, you are not authorized to use the information in this media in any way. Nutstuff does not guarantee the integrity of any media or attached files. The view or opinions expressed are the author's own and may not reflect the view or opinions of Nutstuff. Electronic communications carried within the Nutstuff system may be monitored.